Markets have been volatile in the last month as investors navigate changing tariff policies. So, are there less risky ways to grow your money? Of course, one option is a certificate of deposit, also known as a CD. CDs allow you to save money in an account, while the bank pays you a fixed rate as long as you hold the money for an agreed period of time. But there are upsides and downsides to using a CD. Here with everything that you need to know, we've got Stephen Cates, Bankrate financial analyst. Good to have you here with us, Stephen. So let's just dive into this and some of the details that people need to know about CDs. First, let's just kind of define the length of time that correlates to the return. What typically is that?
Well, CDs can range from a variety of maturities from as short as 1 month, typically out to 5 years. I think the most common kinds that people are going to get are going to be somewhere between 6 months, 1 year, out to that 5 year range. Very, very short-term CDs like 1 month are more rare.
And so why a CD versus perhaps a high-yield savings account?
Well, high-yield savings accounts are going to be very susceptible to interest rate changes. Now, that's great when interest rates are going up, but we're all expecting at some point that interest rates are going to start to fall again. And if you are in a longer-term CD, you have now a guaranteed rate of interest over that term, whereas high-yield savings accounts, they are going to fall almost immediately as those rates drop.
And so with that in mind, what about CD versus a bond, for instance? Because some people may say, well, hey, what you're describing with the CD sounds somewhat similar to a bond. Can you break that down?
Yeah, so CDs are FDIC insured from a bank, which is certainly a satisfying sort of addition to have. And I think people feel good about feeling like they have that kind of explicit guarantee from the government. Now, you could look at something like a treasury bond, again, which has an explicit guarantee from the federal government. But one of the big differences is going to be that bonds are going to be priced constantly. Now, if you hold both to maturity, you're going to get what you're promised. On the same 1 year treasury or 1 year CD, you're going to get the interest rate that you expect, and you're going to get your money back at the end. But with a bond, you may start to notice that the value of that bond is going to change throughout the time that you own it. That can be a little bit unsettling for certain people, certainly in an environment like today where interest rates are moving quite rapidly up and down. That might be something that people simply don't want to deal with, in which case a CD could be another good option. And if you shop around, you may be able to get a higher rate.
Here's something that I was excited to have you define for us. Just what is a CD ladder here, and when do you use it?
So CD ladders are great, and I actually really love them. Bond ladders similarly, but so any kind of laddering product. But it's a wonderful way to balance sort of liquidity needs and higher interest rate guarantees over time. So the way that you might structure something like that is that you take some of your money and you buy different maturities. So possibly 1, 2, 3, 4, and 5 year CDs. Instead of buying simply 1 year or 5 year and putting all your money into it, you'd put a little bit of money into multiple maturities. And that means that every year you're going to get another piece of your money back to reinvest. And it can balance your need for having a little bit of access to your money over time and not being committed to a long-term CD, but still getting a higher average interest rate than you'd get if you parked it all in a shorter-term CD.
The Federal Reserve is expected to continue its rate-cutting path at some point this year, which could affect rates on savings accounts and CDs, but they haven't started yet, and many people are still getting an over 4% return on their money. Our very own Casey Bond joins us with the top rates available right now. Casey, what have you found?
Right. So by historical standards, CD rates are still quite high. And we're seeing right now that the best rates are ranging between about 4 to 4.5%. And that's on terms of around 6 months to 18 months.
So how do you choose the right account and term for yourself?
Right. So it's very important to make sure you choose a CD that matches your savings timeline. You want to select a term that's long enough to get a good rate, but not so long that you're stuck without your money and may need to pay an early withdrawal penalty if you do need to pull it out before the maturity date. Another important factor to look at is the minimum opening deposit. That's the minimum amount of money you need in order to open an account. So some CDs may only require $100, while others might need $5,000 or more.
So what do you do once the CD matures?
You have a few options. One of the best things you can do is take that time to reevaluate the current interest rate environment. You might find that there are other CDs offering better rates at that time, or you may find that interest rates are still on the decline and you want to roll those funds into a new CD at a higher rate and lock in that rate before rates drop again. Another situation you may find is that you need more liquidity and a CD no longer makes sense. So you could move those funds to a high yield savings account or some other savings or investment product that just makes more sense for you at that time.